By injecting money into the car electric industry, they achieve two things at once. First is becoming the world technology kings and then create a cool job for their peoples. However, this success to spark a war because the other countries think that China was too deceitful and providing aid. So basically, smart fiscal policy can accelerate progress, but if it is too aggressive, it can trigger global economic conflicts.
Simply put, fiscal policy is how the government manages its money through taxes and spending. In this case, China is heavily investing in electric vehicle industries by providing massive subsidies. This makes their products cheaper and more competitive compared to the US and Europe.
Now we talk about real interest rate. Look at the paragraph. The paragraph is about the real interest rate in China from 2020 to 2024. Let me describe it. In 2020 until 2021 is the pandemic period, right? The beginning of the pandemic caused fluctuations, but in general, real interest rates were held a moderate level like around 3.8% at the end of 2020. And then because of the central bank maintained its liquidity too. Then in 2020 until 2023, recovery and low inflation, real interest rates start to rise. According to the data from the global economy, real interest rates will reach like around 4.88% in 2023. This increase occurred due to very low inflation in China. Even experienced deflation to China, while nominal interest rates were not reduced drastically. And then to 2024, it's just a peak and adjustment. China real interest rate is recorded to increase further to around 5.09% in 2024. This indicates that borrowing costs are more expensive in real terms for companies as inflation remains weak amid challenges of post-pandemic economic recovery. I will explain it easily. So the real interest rate is the actual cost if we borrow money from the bank after deduction inflation. The meaning is China deliberately keeps interest rate low. Surely you are asking why, right? So the electric car factory have the courage to borrow a lot of money to build building and research technology without fear of exploding interest. So that's the reason.
Gross savings show how much people and companies have compared the country's total income. In China, the saving rate is very high. This allows the government to use domestic funds to support large-scale projects. Looking at the graph, China's gross saving remained consistently high from 2020 to 2024, staying around 42 to 45% of GDP. Although there are slight fluctuations over the years, the overall trend remains stable. This stability indicates that China has a strong and reliable source of domestic funding. As a result, the government can continuously support large-scale investments and long-term economic growth.
Right now, we talk about foreign direct investment net inflows. Let me present the graph again. We know from the graph the FDI of China in 2020 until 2024, the FDI values is goes up and down, right? But why? Why does that happen? Think it easily like this. Real investment from foreign people who build factories or business in one country, not just buying shares, but China has been experiencing problem with this issue in recent years. Okay, let's talk briefly about the graph. In 2020, China became the largest recipient of foreign direct investment in the world, even surpassing the United States. And then in 2021, the value of FDI will increase due to the policy of easing foreign equity ownership in the financial sector and the implementation of the new foreign investment law in 2019. In 2022, many foreign financial companies that had completed their transaction in the previous year will no longer inject new capital, and some have begun to sell their investment asset. And then in 2023, the decline continues drastically from the previous year. This is the lowest level indicated even in the third quarter of 2023. Okay, until 2024, FDI in China inflows will continue to decline due to the deep structural challenge. Its meaning, even though FDI is decreasing, this data shows the need to monitor the strength of the financial system to keep economic activity continuing.
This policy supports SDGs 8, which focuses on decent work and economic growth. China is shifting from low-skilled labor to high-tech industries. As a result, people now have better and more skilled job opportunities.